Good evening, everybody, and welcome to our January workshop, the first of the year, and a great start we have as well. We have Monty and Anthony from Montpac here to give us our workshop on supercharging your finance function. For those of you who don't know me, my name is Matthew. I'm one of the co-founders of the Entrepreneurs Collective, and I've been a founder, co-founder, and in and around startups for essentially my entire working life. And the truth is, over this experience, I've learned probably as much from the mistakes I've made as I have from the successes I've enjoyed. And that's part of the philosophy here at the Entrepreneurs Collective, that by bringing people together to create a community, we can all learn from each other and not just celebrate the wins, but also it's actually so much easier as a business owner if you can learn from the mistakes of others who've trodden that path before you than suffer the difficulties, the loss, financial time, the stress of making those mistakes yourself. So I always like to sort of uh, you know double down on that point that you may be at sort of early stages in your journey, but everything you've learned so far is actually incredibly useful and valuable information to those people who are on that same path as you. So there's plenty of people in this room here tonight, and we bring founders together at our regular event series. I think our next big event is our panel at Samsung on emerging technologies in 2024. So I encourage you to sign up for that one on Eventbrite after this workshop. But by bringing founders and intelligent, creative, resourceful people together, we can all help each other succeed by sharing our experiences. And that's what's making the Entrepreneurs Collective the #1 community for startups and investors in the UK. It's all of you. It's the community working together, not just our small team doing what we can here at EC. As I mentioned, we've got our workshop this evening, our panel discussion at Samsung next Wednesday. But we have a whole host of events that you can see listed on our Eventbrite, from our founder socials, which is a great way for you to come get together with other founders, blow off some steam, share the highs, commiserate the lows. There are no agenda sort of informal event, because we know that being a founder can be a lonely journey, and other people in corporate sort of jobs don't realize what you're going through, and they can't really relate to your situation. So it's a great opportunity to just come together and share a few drinks and some laughs as well, hopefully. We have our pitch competitions. My colleague Louis will drop a link to the pitch competition in the chat, the pitch competition application in the chat as we go through this evening. I think we had about 120 people at our last pitch competition at Homegrown Private Members Club on Thursday. That's 6 founders pitching to an audience of their peers and investors, judged by 3 investor judges. It's a fantastic opportunity for you to tune your pitch, get feedback, and present yourself to an audience of potential investors. We have our lunch series. These are normally sector-specific, sort of invitation-only events. If you're in that particular vertical and you're making good progress, enjoying good traction, then we'd love to have you along to potentially our fintech or upcoming AI lunches. Please do reach out to myself, Louis, about those events, or contact us via the website. We also have our female founders chapter, fantastic community there, very engaged female founders and investors. And although a smaller community overall than our grand EC community, it's actually very incredibly engaged. Likewise with our Black or African series as well. We've got, I think, our fundraising panel coming up at the end of Feb on that particular topic. So make sure you sign up there. Very super engaged communities across both of those 2 groups. And I mentioned already, we have our sort of vertical specific events. AI and fintech are the next 2 upcoming. So I wanted to bring your attention to those. My screen is just struggling to tab. Here we go. As well as our event series, there's a lot more we can do to help. I mentioned, all of you working together to help each other to succeed. That's not to say there's nothing we can do here for you at the Entrepreneurs Collective. We do run a fundraising assistance program through our partners at Alator Capital. If you're looking to fundraise, we can produce investor reports. We can advise on your outreach strategy via email or LinkedIn, and we can help with your pitch deck review. We also have a fantastic pitch practice event, whether you're pitching at our event somewhere else or just sort of walking into those VC meetings. Please come and have a friendly, no pressure opportunity to pitch to our fundraising team and an investor from our community as well for advice, feedback, and guidance. And we've got a brilliant range of discounts and credits, I think circa 60 in total, 90% off HubSpot, 50% off of Dropbox and DocuSign, 25k in fee transactions with Stripe, and actually there's even a Deliveroo business credit in there. If you sign up to Deliveroo with your startup, they'll give you a £50 credit to your account to help you fuel your hungry team as you burn the midnight oil. But that's enough about myself and the Entrepreneurs Collective. The reason you're all here tonight is to hear from our experts, Monty and Anthony from Montpac. They're going to give you a little bit more bio about themselves in their presentation in just a moment. But don't be fooled by Monty's youthful exuberance. There's a wealth of experience there in Silicon Valley. I think he's got exits under his belt to Google. He's done a couple of IPOs. He's been a CFO at startups and on the VC side. So an excellent speaker for us. We're very privileged to have his insights today. And Anthony Williams, head of financial services in the UK, has trodden the path from being an early hire in a small startup that scaled eventually to a corporate sellout, and then remained on the corporate side of corporate sellout. He said it with such disdain. No, that's often the goal for many startups. It can be an IPO, it can be a takeover. So he went through that corporate buyout process, and he's seen that from the inside before sort of rejoining the startup world, which brings us here today. So without further ado, I'm going to hand over to Monty and Anthony, if you'd like to share your screen and commence your presentation this evening on how to supercharge your finances as a startup. Oh, sorry. Also joining us here this evening is Michael Blakeley, our founder and CEO. He also heads up our fundraising function at the Entrepreneurs Collective, as well as sitting across both boards. He'll be giving his insights as well on the fundraising landscape, what we've seen in 2023, what appears to be changing for 2024 as well, and how things seem to be improving. We're seeing some green shoots, I think, from the investment community. Okay, without further ado, please, Monty, I'll hand over to you. Are you able to share? There we go.
There we go. Yes, thank you. So delighted to be here. And I am there we go. So the outline for discussion today, it really is centering around, this current environment, getting to the next level, next stage, and having your financial house in order to get there. And that's something that finance people kind of live in fear of. Well, obviously doing something wrong that prevents an exit or derails an exit, but it's even on the lesser scale, making sure that funding goes smoothly. So that's kind of our focus. In the past few years, obviously at very low cost of capital, high valuations, but things are in a different state now, and I don't think it's a terrible state. So very different fundraising environment. And if you manage through this process, I think there's going to be some great companies created at this time. There's going to be some Q&A at the end. But if I do mention any term or something that is not familiar to you, feel free to ask a question, maybe in the chat. And if you're not familiar with the term, someone else probably isn't either, and it could be helpful to the discussion. So I'm happy to do that. So my background in a little more detail. Been a fractional CFO for about 20 years, mostly in SaaS space, but also in med tech. Another area I think is very interesting. I was also a VC fund CFO in 3 different instances. First in 0102, which was a very tough time because it was after the .com meltdown, but also in other environments that were slightly different. I like to angel invest. I do that through a local angel group here in Sacramento in Northern California, where I'm largely based. And throughout my career, I've helped companies raise over $750 million in angel VC, venture debt, et cetera, and also have been through 7 acquisitions as a CFO. The last one was a small company to Google. It was, even though it was only a 10-person company, it was a ton of work. And I realized at that point, this is, something I don't want to do again. I'm too old. It was, the final straw was around 1 a.m. in the morning, putting in final data into a spreadsheet to determine how the proceeds would be distributed based on the latest, changes to the calculations. And I just went to sleep at that point and hoped that was my last acquisition. But currently CEO of Montpac. We're an 18-year-old firm, a proud sponsor of EC. We're an outsourced accounting firm focused on supporting entrepreneurs. We're not a traditional accountancy in that we don't do audit or income tax preparation, but we do pretty much everything else. We work with a company called Honey Barrett in the UK that handles those functions, so we can sort of provide a complete service. And we've worked with them over 10 years, and they're great people. We focus on inception to exit. That's kind of our tagline, which is, from the early stage. I spoke with a company last week that was founded 4 weeks ago. We also have helped companies get through their funding and through their exit to their acquisition. We also work with a couple small public companies and a handful of unicorns. Last year, we expanded to the UK, and it's been wonderful so far. Met a lot of great people. I'm very impressed with the startup environment in the UK for a number of reasons. There's capital available, there's great IP being produced, there's strong technical talent, and there's also good government support of the startup community, which I think is really helpful. I also am a huge fan of the English Premier League, and that's kind of what spurred, jokingly, our expansion to the UK. But I do need to get better at the football chants. I have a little trouble understanding them and keeping up with them when I'm at the stadiums. But
okay, I'm going to have to interrupt here at this point then, Monty. Hi, guys. Michael Blakeley here, founder of VC. So I need to ask, which team do you support?
I am an Arsenal supporter, and it's been 20 years of not great results, but I'm kind of optimistic about things are going now. Although I don't, having never lived in North London, I don't have some of the same sort of rivalries or anti-Spurs sentiment that a lot of Arsenal fans have. But I don't know how I I read Fever Pitch by Nick Hornsby, and I was sort of familiar with the name Arsenal, and then I started to watch it, and I like that free-flowing passing style. And just once you pick a team, you're not allowed to switch. According to Anthony, you need to get approval by someone who's born in the UK to switch allegiances. So I've stuck with them through thick and thin, and it's been just a great thing to have in my life, because I always played soccer growing up, but I think it's one sort of thing that distracts me throughout the whole year and keeps me entertained. Yeah. So currently, Montpac has just over 300 employees, and we work with about 700 companies. I would say about 85 of them are SaaS startups. There's another couple hundred regular startups doing different things, fintech, medical technology, or what have you. And it's just a pleasure to work with entrepreneurs and to help them on their journey. Anthony and I met when I was CFO of Digital Shadows, which was required by ReliaQuest a year and a half ago or so. He was with the company for 19 years. He's got great SaaS experience. He's in Southern England. And we worked together very closely during those years. And it was very interesting I was brought in by the US VCs to help them expand to the US. They had to do a Delaware flip, which makes the parent company, the US company versus limited. They were funded by Passion Capital and based in Canary Wharf in London. And a lot of the interesting intercompany transactions which have to happen when you're in two regions, US and UK, that was kind of interesting. And I think that it's one of our benefits of Montpac is that we understand both markets well, and we can help people move into the very large US market efficiently. So the startup function, the way I look at it sort of philosophically is that the finance function for a startup must be appropriate for that stage, and it's got to change. And it's helpful to think of the finance function with the end in mind, which is typically an acquisition. There's a series of fundraisers along the way, but ultimately you want to be acquired by a very large company for a very high valuation. Certainly there's a chance you could go public. It's still pretty rare. Acquisitions are a great outcome. So we sort of focus on that and work backwards. And in the early days, you know, this is a cost which may be better spent elsewhere, like hiring some great engineers, spending more on marketing or sales. And that to me makes perfect sense, but it can't be inadequate. What happens is this sort of rears its head at the wrong time. When you're trying to raise capital, it can slow down the process. So we try to not overspend in this area, but always make sure it's adequate and just sort of be prepared for that next stage. And, you know, the finance function is really just, you know, it's a series of fundraisers where you're increasing the value and you can't run out of capital. So you certainly need a finance function which can address that and keep you aware of your situation. One of the points I always make is, you know, it's important to stay compliant. You know, as a small business, you know, you think, oh, well, what do we have to do? We're a small business, you know. There actually are just a few things. Luckily, they're not too expensive to do. And so sort of the cost benefit, I think, is great to have, you know, proper VAT filings, their statutory accounts and corporate tax, and doing things that are not going to be in violation of human resource laws in the jurisdictions that you're in. I think, you know, from an investor standpoint, this can show, okay, you have, and they will look at these things during diligence. So if you have them, you know, completed satisfactorily, it just sort of is to check the box and they move on and they realize that you're kind of serious about running a business. So what, you know, the right level of financial management, you know, the focus, you know, in terms of financial reporting and understanding is largely around burn rate. And then maybe a little later stage, it's around, I think the focus sort of shifts to that and in addition, sales efficiency. So you need to have a system in place and metrics in place to help you understand that. So you could look, you know, I think describe this as financial reporting, which is really just understanding what has happened. The financial projecting, which is, you know, looking ahead and understand where you're going so that you're aware of the capital you have, how much you're burning, and what you're achieving in terms of milestones, which are the things that raise that valuation. And on top of that, you know, you need to be able to aggregate important information like what is your sales efficiency. And what I really mean by that is, you know, if you are expending capital, you know, even $1, are you getting value? Are you creating value in addition to that dollar? A simple way to think about it is if you have, you know, revenue and cost of revenue, you're generating gross margin. And you want to understand how expensive was it to achieve that gross margin, which we call, you know, customer acquisition cost or CAC. And that, you know, what is in excess of CAC will eventually cover other expenses like R&D and overhead. So it becomes more important, obviously, when you have revenue, but up to that point, you know, as I said, you're more focused on burn. So in terms of the financial tech stack, you need a decent set of tools. And I think, you know, luckily, these are pretty inexpensive these days and pretty powerful. They should be low cost, very efficient, but scalable. You don't want to have to replace them. I think, you know, everyone should have a basic accounting system in place, either Xero, QuickBooks Online, or something similar. As I said, they're not expensive. I think it's important to get some help setting them up properly because that'll make them expand with you a lot longer. And in terms of other systems, you know, expense management tools may be something that allows the team to spend a controlled amount on expenses. those can be great. They can give you good visibility and control and kind of free up your time as a founder. So you want to sort of balance this control you have over every penny that's going out the door with your efficiency and your time, because your time is valuable. So in terms of financial reporting, there's three main reports. There's income statement, balance sheet, and cash flows. Those are the main ones. And you probably are familiar with this, but just to be sort of very basic on this, the income statement is your revenue and expenses over a period. It could be a month, a quarter, or a year. The balance sheet is your financial position at a given point in time, usually the end of that period. And all the cash flow does is look at the net income or net loss for that period and compare it to the change in the cash balance. So if your cash went up, even though you had a loss, it's helpful to understand why. And it just looks at the changes in the balance sheet. Maybe you raised an equity round and that made your cash go up. Just so it's clear, what source of that increase or decrease in cash. And it's usually a combination of a number of these factors. So the way we like to present an income statement is departmental. So we organize the expenses, R&D, sales and marketing, G&A. There could be others, or there could be sub-departments. One of the reasons why we do this is because at some point you will hopefully be acquired. The large company is going to be audited, and it's going to be structured in this way. And it's very easy to fold in your results into theirs, which is one of the steps they have to do. And if you set this up properly, it'll have enough detail so you can quickly, very easily analyze what changes from period to period so that you can use that information to manage your business better going forward. And you can have enough structure in there to expand it as your business matures, to have other departments and what have you. I think GAAP, or generally accepted accounting principles, startups should be, strive to be mostly GAAP. I don't think it's imperative that you're 100% GAAP compliant. There are a lot of calculations that are expensive, not that helpful, but I think you should be materially correct in how you're doing your books, and not so you're not misleading someone, because that's going to cause a problem or a correction later that could come at the wrong time. One of the key elements is, are you on the cash versus accrual basis? And the key difference there is when you record the revenue, the income, or the expense. And with cash basis, it's when the cash comes in, you record it as revenue, and when you pay a bill, you record the expense. Now, that is not GAAP. I recommend accrual basis, understanding it, and because it was designed to be a better predictor of cash flows. Also, sort of, you're running a sophisticated business, you're attracting outside capital, you're going to be acquired by an accrual basis company. I think it's easier to transition there. One of the problems we see is, within our SaaS companies, a lot of them get paid a year in advance. And when they've been recording that as income and not deferring it and recognizing it over the period it's actually earned, they have to eventually make that transition. And a lot of times it looks like their revenue has decreased from year to year. And then we have to go back and restate everything, which can be kind of complicated and time consuming. So, the goal of, this is just to get an accurate picture of what has happened, what is your sort of current position. Once you have this in place, the next step is sort of project this. Obviously, projections are a big part of, any startup. And the reason is, you have to predict as well as possible how much cash you're going to consume, because you don't want to run out. And I think that running out of capital is, it does happen from time to time. It's pretty traumatic, and it usually results in a hit to the valuation, puts you in a much worse position to negotiate. So I think it's important to do a proper model. I recommend doing one in the sort of a standard 3-part format, which is there's the output, that's the income statement, balance sheet, and cash flow. There are other ways to do it where you can list the inflows and the outflows, but I think it's important to have it in the same structure as the accounts that you manage on a month-to-month basis. And what that'll do is allow budget to actual reporting. And I think just sort of showing that you're focused on that to your investors is something that differentiates you from a lot of people who are just not thinking that far ahead. We create these using a template. They're multi-year, and in the first few months looking out, they're pretty accurate. You have a good handle on that, but then the accuracy obviously drops. But when you go multi-year, you can show how the value is being created in this company. Sometimes I will look at the value and sort of project at each funding milestone and how an early investor can see their investment increase in value over time through an exit. And obviously exit valuations change from time to time, but I think you can use some standard ones, and it's down the road, obviously. So even if things are trading at 5 times revenue now, 10 times may be realistic when you get back to a more normal market. So the other thing is, starting with the template, is you won't leave out something obvious, like the tax on employee compensation or something like that, that you may forget if you don't generally do accounting. That's one of the benefits of starting with the template. But either way, when you're doing this, it's just a collection of assumptions. And if you're unsure about something, you can ask Anthony or myself. But having something that's pretty dialed in also shows things not only in financial statements, but also in graphical representations. If you can include KPI and metrics, very important in SaaS, but I think it's important in a lot of industries. And it's nice to have something that sort of aligns and supports the company mission. If you're maniacally focused on getting your first customers and starting revenue, I think the model can reflect that.
And sorry, just to chip in there, and super interesting. Thanks, Monty. Just from a fundraising perspective, and hi guys, for you guys who don't know me, I'm Michael Blakeley, founder of VC. The model, I would say, is not quite as important, but right up there in terms of importance with the deck. Certainly when you're dealing with VCs and sophisticated investors, I've seen, so many fundraisers fall apart at the point that you send across the financial model. It's, obviously at the very early stage when you're sort of starting out, some of it is guesswork, but, VCs, I think, very much look at your financial model and they look at it and think, if they look at the quality of the financial model and compare it to how much do you understand and how well have you thought about your plan going forward. If the financial model doesn't stack up and you've missed things, I had one case where I had a founder and he'd done exactly what Monty was mentioning, which is actually he completely missed to put any tax calculations, and had in his presentation that his margin was 20-odd%, but he'd not included tax or VAT or any of those figures. So we went from having a VC that was super interested to frankly thinking that the company was a little bit of a joke, because he was like, well, look, with the VAT included and all these things, you actually end up losing a chunk of your margin. So actually, in fact, your presentation is wrong, and you guys clearly haven't thought your way through. So just to echo that doing the work ahead of time before a fundraise and having those ducks in a row is super important in my experience.
Yeah, that's a good point. Thank you for adding that. I think another area that can be a problem is if you haven't gone through your model carefully and stress tested it and looked at different scenarios, you may be asking for an amount of capital that isn't really adequate to get you to that next milestone, which really drives the valuation increase. And as you probably know, that impact of a down round or a flat round is not felt necessarily by the preferred investors. It's felt by the people holding ordinary shares, which is the founders. So it has a big impact. So I think it's good to really understand how much you're raising feel good about that amount based on a good financial model.
I think I had the question actually last week from a founder who said to me, well, how complex should I make the financial model? And I've got, a really detailed one that I'm thinking of using it, but it's going to be a lot of work. And, my response was, look, I've never known a VC to reject a fundraise because the fundraising model was too detailed. But I've certainly known a lot of VCs to reject fundraising models because they don't have enough detail.
That's a good point. Yeah. And I think they're cascading. They start with summary information that may be included in the deck. If you get to that next step in the process, you should be able to support that. And, financial models should be, defensible, but also attractive. So when you're in the fundraising process, you guys have not gone through it. It's very time consuming. It distracts you from running your business. It's great, it's easy to get excited about the progress you're making. But our view, having done this many, many times, is the more prepared you are, the easier it is. And I think some of the financial aspects are easier things. So assuming you are fundable, at a very high level, you're solving a real problem and you have a great solution. It's a large market. Your team is strong and the right people to do it. The economics make sense. And also, the amount of capital you're trying to raise is reasonable for the stage you're at. Just be prepared. I think knowing, having an idea of the type of capital you want to raise, whether it's a priced equity round or a convertible note, I think that's helpful, but I would be open to it. Ultimately, the investors are going to want to have a say in this matter, and there's always ways to make it work. But if you can just be prepared as possible with all your ducks in a row, and we're going to go into that in a little bit of detail next, I think, hopefully it's the financial aspects of the diligence is the minor part. It's just sort of checking the box and going through it, and you go through it quickly, and you don't have something that slows down. I've had many clients through the years who are working with a VC, and the VC is excited, they're excited, and they go, we just need to see your financial model or your financial statements. And they go, we don't have that. They go, okay, we should talk to Monty. I've worked with him before. And then you start to work with the client, and it takes you a while to get to that point. And so it slows down. The VC could get distracted. There could be, events in the world that change the big financial picture, like 9/11, things like that can happen. So just make that period as short as possible. So if you're not doing it, you're going through all the motions. It's like, controlling a football game, but not actually scoring. And Arsenal did that recently against Liverpool, if you were noticing. It's very frustrating. But enough about that, Arsenal. So getting through diligence, it kind of varies in complexity depending on what stage you're at. If you're early stage, there's not that many things to sort through. But I think, one of the things, you have the right entity. In the US, we have LLCs and C Corps. You have limited. You probably have other structures. VCs in the US invest in Delaware C Corp, so a certain type, most common type of corporation. Delaware happens to be the state where it's incorporated. And I had an example. I was working with a company many, many years ago called Engine Yard. They were ultimately funded by Benchmark. But when they started, they spun out of another company, and they just sort of raised money and opened a checking account. And actually what they did is they formed a partnership. And I noticed a press release that they had raised money from Benchmark, and I reached out to congratulate them. And when they said, well, let's meet for coffee. And they said, we talked to a number of people. You were the only one that brought up the fact that we were structured completely wrong. And it cost $350,000 to fix that. So that's an extreme example. But it's one of those things that, if you have that basic structure in place, which hopefully you all do, it's not a problem. It's not a delay. So to get through it, I think you need a supporting team around you, a great legal advice, financial. If you do have great legal, you're going to have the right type of entity. But one question is, it's not just any attorney. Are they the right team? Have they gone through this process before? Are they going to add value, beyond what they do in terms of connections? And obviously, again, compliance to make sure you're in compliance with companies, VAT filings. People always check on this. Sometimes they check at the last minute and it delays the close, and that can be very frustrating. So cap tables are one of the things you have to have in place. It's pretty straightforward. It's just a schedule of who owns what portion of the corporation, but there can be a lot of nuance in it because there are classes of shares. And I think if there's a lot of times these shares are created at the time of the fundraising, so you're negotiating on the structure and the rights of these shares. But it's important to understand, one, who owns the shares, currently. I invested last year in a company that's involved in software that manages mental health patients at large hospitals. And oddly enough, the two founders, a few months after I invested, left the company. One of them was kind of crazy, so that kind of makes sense. It's a mental health related company, but they still have a huge amount of the equity. And when the VCs come in and look at that, they're like, well, these people aren't involved. That equity should be for the active founders who are growing this. So it's going to be kind of a problem. So that's got to be resolved. And it's similar to having, equity allocated for your EMI schemes, stock ownership. You want to be able to attract talent. And so just make sure you have a cap table in shape. It's one of the things that is definitely going to come up in the fundraising process. The financial model, I think, to sort of rehash a bit, it tells a lot. It shows sophistication. There are people that can help you with it. One of the things we do at Montpac is we do due diligence for VCs and private equity firms. And this summer, I was doing diligence for a VC on a SaaS company based in London. A very nice company. The founder was still doing sales, was getting great results, but he hadn't done the books thoroughly and properly. And when the VC was going through and looking at the growth rates of MRR during that period, he couldn't get his arms around it. And I said, well, let me sort it out. And we did that. And the results weren't what he didn't want. He wanted something a lot more to invest in. Not a lot more, but the time it took to get there sort of distracted him. And he basically just moved on, even though when he told me, he was like 75% sure he was going to invest. So if you had a proper model in place, and I truly believe that if we had his revenue, the entrepreneur's revenue sorted out, we could explain it. And then we incorporated his current pipeline with his close rate and showed that he was very close to a very good inflection point that would have driven the valuation up and ultimately helped him raise around from a great VC who really knows the SaaS space. And I think it's one of the interesting sort of anecdote of what a good financial model can represent for the company. They need to be realistic. You have to believe it, but it's also got to show some strong potential. So you can't make it too conservative. So I'm not saying lie or put in bogus information, but I'm saying something. It's got to be attractive and realistic, and find that balance. Stress test it, different scenarios, taking out revenue, delaying revenue. Those are all great ways to really understand it. And then if you have someone like us, we'll often are in the meeting supporting the model and describing it and defending it.
Yeah. And maybe just one thing just to chip in there that I've been seeing from the fundraising side is, I think one of the really important things, for many years or before the market got a little bit tougher, was people wanted to see this hockey stick curve And you know, it was like, look, if you didn't have exponential growth, you know, it was very difficult to get VCs interested. It was, you know, the question was, well, you know, especially from US VCs, you know, where's your ambition? Like, we want to make 100, 500x. You know, if you're not going to be a unicorn, we're not interested. Though interestingly now, I think one of the questions that I've heard more in the last 12 months than I've ever heard before is, when will you be profitable? And where's your route to profitability? Which I think is a key part now of the financial models, which is, you know, and I think partly also with, you know, based on the fact that we've seen many of these companies, the WeWorks and of this world, who frankly have never actually built a profitable business, but just taken a lot of fundraising. So I do think there's a push more to also see that profitability as well.
It's a great point. There's been a shift in attitudes towards that, and I think that is it's something I touch on a little later. But the one final thing I think on diligence is having a data room. You can Google Drive. It's probably something that you already have that's free or low cost. Organize it logically into folders, and it's sometimes helpful to base it on an actual due diligence checklist. Keep it updated regularly. I think that this is good, just proper corporate hygiene to have this. One thing I come across sometimes is there's documents in there that are not signed, or the final document. Those don't really count, especially in acquisition due diligence, but even it's helpful to have these along the way. And then when you do get some interest, I don't think you have to open the kimono all the way right away and give them everything, but you can create a folder for them and add to it. But you just do this very efficiently when you've already had this set up. I think it's just a good discipline. It becomes, this is a small scale dry run for what happens during an acquisition. And so that is a much more, complex task, but I think this is good sort of practice, so to speak. So yeah, getting back to sort of what, Michael was talking about, it was grow at all costs, and that's because capital was free flowing. And there's always been great examples of this. Amazon raised all the money they could and tried to expand beyond books to get into every market they could while the capital was cheap and being offered to them. And that worked out well for Amazon. It did fuel a ton of unicorns, and I think the problem with being a unicorn, I mean, it's great to be a unicorn, but there are just fewer other companies that can acquire you. Whereas if you're, worth, 3 to 500 million, there's a lot of them that can do that. And so you almost kind of directed towards going public, and the public markets may not be receptive to IPOs. So that's not great. So in terms of, capital efficient, capital is expensive. So you always want to be capital efficient. I think in this environment more than ever. So it's no longer growth at all costs, but eventually people will forget that and go back to, raising tons of capital, growing like mad. But they're going to forget that it doesn't always work out that well. And I think there's a lot of examples. My personal view as an investor is I want the company to survive and make me money. Unlike a VC, I don't have to report my returns to anyone. The reason why VCs are so focused on these fast-growing companies is because historically, in a fund of 20 investments, there's only one outlier that makes a huge return, and that makes the IRR, which is the internal rate of return, how they're basically measured for the whole fund. And so there's so much risk and so many companies that don't make it at all. The ones that, as one friend of mine said, who was also a VC fund CFO, he goes, you can 2 to 3x your way to death, meaning a bunch of small returns won't give you the IRR that you need. And so there's always going to be this, emphasis on growth, but you also have to survive. And so it depends on what stage you're at, of course. if you have revenue and the revenue is somewhat flat, you know, maybe, you know, you have to carefully look at the capital you have, what your current investors are thinking. Are you you're going to turn into what we call the walking dead, which is when your valuation is sort of below your what you've raised at, but you're also cash flow neutral, so you're not going to go out of business. You're kind of in this weird state where eventually you have to exit, but as a founder, you wouldn't achieve much because of all the preferred stock ahead of your position. So they have to do a carve out, and you know, these companies can go on for years until they're eventually people move on with their life. And I've seen one instance where the VC just gave their equity back because they were closing their fund and there was nothing going to happen to this company. So you have to find the way to survive and thrive. You know, PE funds have a different sort of mindset. They take less risk. They invest later stage, and they're not looking for that massive return, but they also don't do small deals. So you have to be at a certain size where you're typically generating, you know, some EBITDA. I think one key point is, you know, communicate with your existing investors if you have them, and that'll make the whole process easier. You'll stay on the same page. You'll get their support. And that's sort of my thoughts on growth versus capital efficiency. It's very particular to your situation, but it is clearly not what it was, which was, you know, free capital, grow at all costs. So these are my thoughts. And Michael, feel free to chime in, or we can take questions. I think, you know, deals are getting done. You read about them. I think there's other inside rounds, maybe bridge rounds, notes that you're not reading about, people aren't talking about. I think there's you know, a lot of amount of capital on the sideline still, sort of waiting for, you know, the right time to get back in. So investors will be cautious. There's obviously a lot of excitement around AI these days. I think it could easily, you know, that's a little tempered by maybe, you know, government control of laws around AI to protect people, intellectual property concerns, copywriting. You know, ChatGPT got sued by the New York Times, but I still think it's amazing what it's doing, and it's going to drive a lot of innovation, obviously, as it has for years, and capital. IPOs kind of few and far between. I think there's a lot of companies that are able to go public, and what it effectively does for, you know, startups is it sort of energizes the whole capital community. It returns the funds, returns money to the funds. The funds return it to limited partners. They get a return. They're then, you know, funding the next fund of the VC fund, and it sort of keeps the whole cycle going. Private equity firms and public companies, if they were acquiring startups, that would be great. You know, the interest rates being high, whenever a private equity firm uses leverage, it makes the cost that much more. But I think some great companies are going to be created and thriving in times like this. There's always stories of great companies that were started in downturns, and I think we're sort of moving out of this downturn. We've digested it at this point. And, you know, I'm investing my personal funds in things. I'm excited about the valuations. I'm not looking for the cheapest valuation. I'm looking things that are at that inflection point. I invested last week into an AI company that had I invested in a safe with an $80 million cap, and we had a discount from that. But they were, you know, this could be all, you know, BS, but they were saying, we're closing this now and we're going to do another safe and invest at 150 million. I'm like, okay, I don't have a lot of time to decide. My Anzu group was doing it, so I put some money into it. I liked what they were doing, but I was not worried about the environment. I think this is a great time to invest, and I think it's a great time to raise capital and to start these relationships. And so if you can, you know, prepare yourself to be ready for this, it'll go, I think, a lot smoother, and you'll differentiate yourself from the other people looking for money right now if you have all your ducks in a row.
Great stuff, and thanks, Monty. And maybe I'll just sort of cover a little bit on the outlook for 2024, and a little bit of what we saw in 2023. And then maybe I know there's some questions that have come through in the chat, some really good ones. So then we can loop back around and answer some of the questions. But just to sort of quickly just give you a quick intro, my background is as an M&A lawyer. I previously worked at Freshfields, Tata, and the UK Competition Authority, as well as the Kinnevik Group in Stockholm, Sweden, who were buying and selling startups in the £5 to £500 million space. So I've spent a lot of my professional career helping startups and companies to get ready for M&A or fundraising, and also through EC in our sister organization Alator. We work in the fundraising side, and last year we saw hundreds of decks and also spoke to hundreds of VCs, angel investors, and some private equity as well. And deals are getting done, but what I would say is, last year was tough. Like, I think anyone who closed a fundraising round last year, hats off to you. I saw a lot of down rounds. I saw a lot of companies go under. I saw people having to maybe speak to 70 or 80 people, whereas maybe in 2021 they would have closed their round in sort of 10 or 15 conversations. And we even saw some of the top VCs that I won't name really struggling to fill out their rounds. And these are sort of household name VCs that normally send an email or a WhatsApp to their other VC friends and quickly close the round out. But it's not all doom and gloom. I think from sort of October, November, December last year, I think we probably saw more activity in the last quarter than the rest of the year. And I think potentially that's for two reasons. One is there was a period of stability. Obviously, in the first half of the year, we had everything from, obviously fuel prices that, impact startups, lots of startups going under, SVB. All of this just leads to a feeling of uncertainty, and the high interest rates mean that actually, if you're an investor, you're actually getting pretty decent interest rates on your funds, and in a risky environment, actually sitting on your cash is actually way more profitable now than it has been for a very long time. So you are competing as a startup with other investment opportunities. So I'm going to divide my feedback into two areas on the fundraising outlook. One is, I think, looking at the earlier stage, which is angels. Now, what I would say is, from one perspective, angels and the SCIS side, angels who are deploying, I would say I'm probably seeing maybe only 30–40% of angels that were deploying 2 years ago, I would say as a rule, are still deploying, mainly because so many companies went under in the last 12–18 months, that for an angel, if you've got a portfolio of 5 or 6 companies and 2 or 3 of them went under, plus coupled with that, your mortgage, if you've got one, has gone up, your fuel prices. So if you own a business, or if you're spending, all of those things, and your day-to-day living has gone up, you do feel, if you're an angel, and I'm not talking about the super high nets here, because those are a bit impervious to these sort of fluctuations. But if you're I guess a sort of average angel that writes 20 to 50,000 pound checks, you will feel a pinch from all of that. The early stage SCIS funds, these are the guys that, there's probably the best part of a dozen of these in the UK. Those are pretty much largely unaffected, mainly because they've got the cash, they've got to deploy it. They tend to make most of their money on fees. So actually, by not deploying, then the funds aren't making money, and their cash is already there. Whether they might have less in coming years is another thing. But SCIS still seems pretty lucrative. And if anything, it's probably become slightly easier because there are less startups launching, because the market is tough. Actually, there are less earlier stage startups starting than that coming into existence than they were maybe 2 years ago when the market was more robust. On the VC side, I think as Monty rightly pointed out, I am optimistic. In particular, I think if we can get 2 or 3 months of stability now, where the economy is generally positive, and we've seen some early signs of that, certainly in the UK, in the US, then I think we can see some return to more fundraising. I think it's going to be similar to last year. I think it is going to be quite heavily dependent on your sector. So I do think if you are in AI, to some extent that is super attractive, but also there is a big pushback now against what I would call fake AI companies, which is people who are calling themselves AI but don't really have any AI in their arsenal. Because I think a lot of people have just got, frankly, frustrated with dealing with AI companies. So I would encourage you not to put an AI in unless you're genuinely genuinely doing something. But I think climate tech is another one. We saw a big increase. Last year, climate tech was the only area outside of AI that increased in the UK in terms of investments. Everything else dropped. Fintech investments dropped about 30%, and it would have been more if it wasn't for a lot of the overall fintech rounds. And consumer and B2B also dropped in terms of overall investment. So, but I think, as I say, as we go into 2024, I expect that there will be around, a continued interest in AI. I think you will see more angels coming back to the table, especially in the new tax year, but also some others who I think with this period of stability may try and get rid of their SCIS before the end of the year. So I think we're going to see a bit of a flurry then. And also in terms of the VC perspective, I think there was a lot of, I was looking at some of the VCs before I came on here to have a look at some of the ones that that I would see and generally invest. And you look at some of them. I looked at one the other day, MGM, which is the Mail Group. They did 5 investments in 2022. They did 2. They did 0 last year. But they have 4 people in their ventures team, right? So they need to deploy, right? They're paying salaries for 4 people. You're sitting on cash, and people are, so you need, so a lot of these guys who maybe have skipped or took a bench last year are gonna start feeling the pressure to deploy. So I think we're going to see some more of that coming through. I think you're also going to see, I guess, a second wave of fintechs coming through, which is, there's been so many payment processors, there's been so many QR code companies, and there's been so many neobanks. But now we're nearly at the second wave of fintechs, which is, where we're really seeing traction is very niche fintech products. And the ones that we're seeing that are raising substantial rounds are ones that are niche products that maybe aren't in the current portfolios. Because frankly, if you're a payment processor or a QR code company, all the major fintech investors already have at least 1, if not 2 or 3 in their portfolio. So it's very difficult to raise in some of those main areas that have been fairly popular over the last couple of years. So that's, I think, just I guess a sort of overview of how I think a fundraising will look. And certainly what I would say is, even in the first couple of weeks, I have, had some VCs come back to me, and even some private equity You know, I spoke to one private equity company in the US who basically said that they considered that this was the bottom of the market, and this was the time that they would be looking to either invest or buy startups that were struggling, because valuations are good. So yeah. Oh, sorry, I lost a bit of light. So I think that's it. That's it from me. I'm going to open it up to questions. I know there was a couple in the chat. So maybe if I go back and we pull some of these up.
I'll jump it up into sort of keeping a running tally as we go, Mike. So yeah, I'll start with some of the questions that have been dropped in the chat as we go. I guess it's directed at Monty in this particular case. We're a UK operating tech firm. We've raised VC equity in USD, but our cash burn is all in GBP, and USD has moved sort of plus minus 10% in the last 52 weeks. How would you protect your runway against such a significant risk?
Yeah, that's tricky, because it's very hard to, predict FX, changes, and there's not really our jobs. Well, we have the same issue because we have, several hundred people in the Philippines. The dollar happens to be pretty strong. I think that's just unfortunate. I don't really have a good answer on that. But hopefully things sort of over time return into your favor. Yeah, that's a tricky one. I guess I've been fortunate to charge dollars and pay largely in Philippine pesos, and that's worked out well for us. Our agreements with clients do have a clause in there. If something changes dramatically, we can adjust our pricing. We never had to do it in 18 years, but yeah, good question.
Okay, I guess there's sort of tools like futures, options, hedging strategies out there.
Yeah, there's a cost associated with that where you keep the money. The treasury function, from a VC standpoint, is you take a tremendous amount of blame trying to go for yield if something goes wrong, but you don't get charged if you don't achieve yield, but keep the principal secure. Yeah, so I think I would just keep the money in recognize there's a cost of converting from dollars to pounds. I think we would do that kind of cautiously at Digital Shadows. We would do it in bulk, negotiate the fee with the FX people. But I think the US VCs wanted it in dollars for the most part at the holding company level, and then we moved it to the two operating companies, there was a US and the UK operating company. But yeah, you could hedge it. There has to be a fair amount of money involved, and hopefully things have stabilized and are not continue to worsen your position.
Okay. Next question. Why can't founders have preferential shares? Why must they be ordinary? No, I didn't know that was always necessarily the case.
Yeah, no, I think there's no like hard and fast rule, but when you form a company, you generally form it with ordinary shares. And then the investors are putting in dollars, hard dollars. They want a preference for that. They want to be in a first position at a liquidation. They may have a lot of more onerous terms than that. I don't think there's anything saying you can't have, preferred shares and be, pari passu with your investors, but they may not, want that, or they want to be in a stronger position. And maybe that they would view it as, well, you should just stay in your lane. On the other hand, I have seen founders invest dollars, especially repeat founders, in the preferred along with their VCs. And that was not, they're obviously paying more for the shares because preferred shares with that preference cost more than ordinary shares. It was sort of a good sign that they were, true believer in the mission of the company. But I think in general, there just needs to be, there's sort of a difference between people who are writing checks for shares versus people who were, got their shares through organizing or through options. But it could happen.
Next question. I think we touched on this a little bit earlier about the sort of the hockey stick growth curve. Whilst it was always exciting for growth, doesn't it make an investor nervous because that's going to be backed by the same line, a similar curve in expenses?
Yeah, I think that, anytime, and this is a nice thing about graphical representation of the results, you can easily see those inflection points. You have to have the understanding of why that inflection point is going to happen. If product one is progressing along and at a reasonable growth rate, and then you're going to have this hockey stick that goes up, it could be because of the launch of product two. That's an event that makes sense. All the other expenses need to reflect that as well. And so I think, yes, it can look bogus, make investors nervous, but if you have the explanation and probably preempt it with the discussion about it, and maybe it's something as nuanced as we think, the second product or this feature we're adding to the product will open up our market, and we're going to convert, upgrade, close a lot more, something that's going to drive this increase in revenue, which is that hockey stick. Then I think, they have to look at it as a little more serious and likely to happen. They still may question it, but they shouldn't be as nervous about it. But they do look bogus because, I remember asking a CFO, it's like, well, what's your projection look like? He's like, up and to the right. What do you think? It's kind of like, it's expected, and but there are things do happen. There are hockey sticks in real life too, but I would be able to explain it and not be overly aggressive with it.
Okay. This one, can you ask some of the really tough questions that you've seen VCs use to stump first-time fundraisers?
Yeah, I've seen a couple that were pretty funny. One was one VC had actually done pre-call research and looked at the competition in the space and had some notes about them and asked the founder, it's like, how do you compare with this company? And one of them he knew and was pretty well prepared to defend it, and the others he did not know. He hadn't been thorough enough to understand who else was in his space, and that sort of caused pause. And I think he came back with some good responses, but it wasn't in the moment. I've seen another around go-to-market questions. I saw a very sales and marketing minded VC ask, how long does it take to ramp up your salespeople before they start hitting these numbers? And it's something that hadn't occurred to the founder, who was more of a technical founder. So when you hire a salesperson in a good financial model, it may take them 4 months to get to quota. And so if you just plug in your assumption, it's like another salesperson, another 30,000 a month in bookings, that's not going to happen. It's going to be 0, 5, 10, 30. It's going to ramp up. And so I think a good model will reflect that. But it was just sort of exposed an area where this founder hadn't really been thinking about it, thought about it too simplistically. So those are some of the things. Other times they ask questions, well, what happened if you moved the revenue out 6 months? Like, oh, well, that doesn't work with our model. We'd have to retool it. A lot of times they want to know what are you actually going to spend, and look at that without factoring in any cash coming in from revenue, because that's not something you can control. You can control what goes out, but not what comes in necessarily.
Yeah, and I think just to sort of jump in with a few from my side as well. I think some of the ones that I sort of see that I think obviously the standard ones, like where are you going and where do you see an exit, and what is the biggest risk to the company. I think those ones are fairly sort of standard ones. Some of the ones that I've seen stump people is when the questions are asked in a slightly different way, like why do you think the world needs another company like X. I saw that asked to one person, and I don't know why, but just phrasing it simply differently. Obviously, the answer could be as simple as, well, we're solving a problem, right? And then you go on and talk about your problem. But I think a lot of the toughest questions where I see people flounder is around, I think, as Monty mentioned, things around the finances and knowing your numbers. I think it is, to some extent, it's better, I feel, in those circumstances when you don't know the answers, to actually just politely say that, look, you can come back and that you'll follow up with the answers, than take a punt. Though I have probably slightly less risk appetite than some other people.
I think in certain questions you can do that and it's no problem. A lot of times you hear the question to a founder, it's like, what are your thoughts about remaining CEO or bringing in someone to become CEO? And it's kind of like it's to poke your ego a little bit, and to also understand, are you a team player? And I think you got to sort of have your story for that, and I like the fact that my counsel would be, well, I'd be certainly open to bringing in a great CEO. I would expect this person to have, scaled amazing companies, gotten through great exits. We all would benefit from that. I'd be cautious to have it detrimental to our culture that we've created here. We've got, a really strong team, and sometimes there's this culture clash from large company CEOs coming into a small enterprise. And so, that could hurt, but yeah, I'm totally open to it.
Yeah. Another good answer that I sort of see when you get some of those tough questions, like, where's the company, and would you change personnel, and would you sell if someone approached you, or are you going to IPO? A sort of good default question is essentially that you will, do what is in the best interest of the company and your shareholders to maximize returns. I know it's like it's a bit of a thing, but the reality is your interest should be aligned, generally with investors, which is you want to make us, this is business, and you are looking to make a return for yourself and those guys, as well as build a great company and solve a problem. So I think there are some good sort of answers that you can have there as well.
I think it goes beyond just the shareholders. It's all stakeholders. That is your employees. That is your customers that are relying on you. If you have something, that is mission critical for your client, for your customers, you have to, ensure that they can operate. And I think if you have that, a little broader view of like, who are the stakeholders, it shows that you're kind of in it in the long haul. I think there was another question about CapEx. The way I model CapEx is typically headcount driven, per, one laptop per person, or maybe it's a more powerful workstation for engineers, and then look at other things that are required. CapEx kind of shifted to OpEx, with AWS. You aren't buying servers, and putting them, you're just, buying space in the cloud, so to speak. So it got a little easier, but understanding how those things scale as well can be tricky. And they should get more, lower cost and more efficient as you do scale, with pricing improving, but it will increase. So CapEx, I think it's a part of it, because it does, consume capital. You can't forget about it, obviously. So if you have something in there that covers that, hopefully CapEx is a smaller part of the spend versus personnel, but that can change over time.
Yeah, I think most things are available as a service now.
Yeah.
So
OpEx versus CapEx, yeah.
Yeah. Okay. And any further questions or insights from Michael Monty you'd like to share? No, I think it's been a pretty comprehensive workshop. There was a couple of questions on particular jargon, which I tried to field in the chat. So I think ISBS and CF, income statement, cash flow, balance sheet, was one that came up a couple of times. But I guess I'll talk to you, Monty, and maybe we could put together a bit of a sort of jargon cheat sheet as a resource to accompany this sort of deck and recording that goes around to help, some people who aren't so familiar with this function.
Yeah, or Anthony and I would be happy to chat with anyone, go through their deck, give feedback, go through their financial model, give them some pointers and some things that could improve it, and then an explanation, of anything that's particular to your situation that we've covered today that you want to drill down on. I'd be happy to do that. I think when you're working with startups and entrepreneurs and as a service provider, you have to think about it a little differently. Without entrepreneurs taking that risk, starting companies, getting excited and passionate about things and growing them, the service providers have nothing to do. And so they have to be supportive, and that's not always putting yourself in the position to charge your fees or whatever. It's really just to help, entrepreneurs with that tough task of being an entrepreneur. And I think, also in the same vein, service providers should bring more than just their area of expertise. They kind of have to bring their network to their clients and really help support that startup. So for us to spend a half hour on a call, no big deal. Love to meet people, love to find out also what interesting things people are working on. I learn a lot about technologies just from hearing people who have left university and are working on something that they're a postdoc, and you're like, interesting, how's this going to commercialize? Is this how's this going to change the world? And then in doing so, you learn about new things, which is great. That's one of the fun parts about the startup world. It's new all the time.
From my perspective, having you join one of our pitch practice sessions, or maybe sit on the judging panel for one of our pitch competitions, would be fantastic, Monty. Those questions, pretty tough, and you had textbook answers in mind yourself. So it'd be interesting to see how our founders match up to your expectations and experience. There is just one more question in the chat. How do I get in touch with Monty? If we could tab back a few slides, I think we had Monty and Anthony's contact details there. We'll leave those up for a few more minutes. Please jot those down. If you scroll back,
obviously there is the LinkedIn links in the chat as well. So if you want to reach out by LinkedIn as well, or by email, both are. But obviously we will circulate contact details when we reach out as well.
Yeah, and I'm in California normally, travel to the UK, 3 or 4 times a year. Anthony's in the UK. I think I'm going to next visit when the days are a little longer. I looked and it was like the sun was going down at 3:50 in the afternoon. So that seems kind of bleak. But maybe when it warms up, I'll be back. But I could also come at any time, meet in person. Anthony's available. I can talk any afternoon after 3 p.m. your time. Typically, I'm up. I'm kind of work around the clock sometimes because of where our personnel and clients are located. We have clients from the Middle East, Iceland, the Nordics, all across the US, Hong Kong, Singapore, a lot in Hawaii. You're welcome to visit me.
Yeah, I was about to say, I'm sure that people. Don't worry, we'll come to you, Monty.
Yes, Hawaii. Come to me. That sounds good.
Perfect. Well, thank you very much, so much, Monty and Anthony, for this evening's session, and likewise, Mike, for giving your insights from that perspective. That concludes the presentation for this evening. We'll be circulating a copy of the slides and a recording of this evening to everyone who signed up within about the next 48 hours or so. But if you have any further questions and you still can't reach Monty or Anthony, come through the team at EC. We'll be happy to redirect you. Please, everyone here in the UK, enjoy the rest of your evening. Monty, I guess it's breakfast time or maybe brunch where you are.
Lunchtime.
Yeah, so please enjoy the rest of your day, and we'll see you all again soon at our next event. Thank you very much. Good night.
Thank you for having me. Bye.